Hello, welcome back once again. We're going to take a look at a company and a stock that was suggested by one of our esteemed subscribers and viewers of the channel. So thank you for this suggestion. Looks very interesting actually, and I wanted to take a little bit of a closer look. This is 1-800-Flowers.com, or FLWS as the ticker symbol is. And you will see here that the company has actually been trading down lately, I guess with the rest of the market, so that makes some sense. A 1 year loss of almost 50% may actually point to an interesting purchase for us right now over here. So I wanted to examine the company. Let's first take a look at the outstanding shares here. And we are noticing that the company has been issuing a few shares here, but also buying back some shares. And the actual increase in outstanding shares is very, very little compared to where it was in 2014. It's almost negligible here. And I kind of appreciate that from the board of this company, because look at this run over here. The company has been running a lot, and they could have actually sold some stock, and it may actually have been the proper idea and the proper thing to do for the company, because they could actually fund themselves with this extra money just because the stock was going higher and higher. Yet they didn't actually dilute investors. So there is you can see it both ways. I mean, it's good for current investors, so it gives you more confidence to keep holding the stock. Yet they could have made a little bit more money. So as an investor myself, I appreciate that, I have to say. So the short interest of the company at about 5% and dropping really, I guess because of the steep drop over here. And let's take a little bit of a closer look now at the income statement of the company. We are always going to do our usual discounted cash flow model at the end, just to examine how much to pay for the company today. Before we proceed, if you're new here, please leave a like if you enjoy this type of videos, because that really helps grow the channel and bring the content to more people. It's a small token of appreciation, I suppose, and it's totally free, so thank you for doing that. And if you're not a subscriber, you may want to think of becoming one, because I'm creating content daily, and I'm pretty sure you will be enjoying this kind of investing type content if you are a value investor yourself. So the total revenues of the company here have been growing till 2021, and you will see that there is a regular increase here in the growth of the company in terms of revenues, and a little bit of a decline in the last 12 months, which you could kind of expect, I guess, from a flowers company due to the pandemic maybe. I mean, it can happen a little bit that the company can lose a little bit of its steam. They still grow 20%, so that's acceptable for sure. And the net income of the company is sitting at 90 million from 44 in 2017. So not too much growth here in terms of net income, but they are doing better at least. And this is a small company. This is less than $1 billion company. That's something to bear in mind as well. So don't expect insane revenues here or insane free cash flows. So the assets of the company, we are looking at the total liabilities that are sitting at almost 800 million here, and the total equity of the company at 565, which is fair. And there is a little bit of debt here for the company, as we can see. The cash flow, the net income here, as we examined, it's generally speaking increasing. 2021 was the best year. And the cash from operations is positive, which is a good thing, of course. There will be some capital expenditures that will be extracted from cash flow, of course. But the cash from investing is in the negative, which is a good thing, because the company is spending some money for acquisitions. So that's good to see, very normal stuff. The cash from financing from the company, it's repaying debt. And you see that they are repurchasing stock instead of actually issuing shares. They are not issuing shares, really. You would have seen... as you are seeing in the issuance of common stock, very little share being issued, very small amount of shares being issued here. And the next thing that we are going to be examining is the free cash flow, of course, which has been positive in 2021, negative in the last 12 months. So last 12 months haven't been treating the company very well, which is pretty much, I'm assuming, why they lost a lot of their market share and a lot of their market cap, really. And not necessarily share, but they lost a lot of their market cap, and they seem to be losing some money in the last 12 months. That can happen for a year, and the company could go back to normal. we do need to pay to take some care about this one, to pay some attention for our projections in the future, because it's the latest year that we have over here. So we want to give it a little bit of a discount, a little bit of a margin of safety for our investment because of that, because it's like the last 12 months have been the worst. The multiples of the company are 0.4 over here, very small multiple, very low multiples. So this is very cheap in comparison to the previous years as well. Like, look at that. Even that is cheap. Like the company throughout its history has been cheap in the last 5 years or so. Profitability is 17% is acceptable for sure. It's not bad at all. I expected lower to tell you the truth, although it used to be 26 in 2021, was the greatest year. Solvency here, yeah, there is a little bit of debt. Total debt to equity is a little bit higher than I would like it to be, but it doesn't concern me too much though. So the next thing that I want to do is go to my tool here and examine the company's free cash flow and the revenue, net income, and free cash flows, and see how we can use this information to build a model here that will calculate how much we should be willing to pay if we want to buy the company today. And the first things to notice here is that the revenue has been increasing. In 2021 was their best year, and there is a small net income margin, which is very interesting. So if you take a look at the net income and compare it to the revenues, the net income is a very, very small percentage of their actual revenue. So they need to make tons of revenue in order to make little net income. And that's a little bit worrying. That's something to bear in mind, the small income margins here. The free cash flow of the company is, generally speaking, pretty good here. And generally speaking, again, increasing. And the free cash flow margins are, over here in the last 3 years, pretty nice, actually, pretty good ones. So let's take these averages here of this table and calculate our projections. So the revenue growth that we're going to use here, we're going to go a little bit more conservative, as I said. We're going to go 8, and 9, and 10, because again, we saw that the company has been losing money in the last 12 months, so we want to be more conservative than normal. So 8, 9, 10 I think is fair for the next 5 years. The net income now, I'm going to go 1, 2, and 3. Again, I'm going to be conservative. I'm going to be below estimates in order to get a margin of safety in the case that the company won't be doing well in the next few years. That's what we have to do as investors, calculate all the scenarios based on what the company has been doing historically. And since the last 12 months haven't been the best, we want to give a little bit of a leeway. That's the point. For free cash flow margin, I'm going to go 90, 95, and 100. And the annual return that I typically want to get is 13% a year, because you can get about 10% from an ETF, S&P 500 ETF. And so we're going to calculate here. And we're seeing that for our low projections, we are actually currently a little bit overpriced. But for our medium and high projections, which are still relatively underpriced, actually not underpriced, I'd say relatively conservative, I'd say that this is actually fair here. And the current price is sitting at 14, so this is a green, as you can see, and it would be a green till 21.33 was reached. And high is these estimates here. Revenue growth of 10%, which I think is very achievable. Net income margin of 3%, which is close to the 5-year average, probably also very achievable. And a high free cash flow margin of 100%, which is again less than the 5-year average, so also potentially very achievable. So I think that's maybe the most accurate measure here. But even if that's not the case, the medium one is also fair, and we are still below that. So based on this model, I feel that with relatively conservative estimates here and projections, the company is potentially interesting buy to my eyes. It looks very, very interesting, and I like the fact that it has given us a steep discount here. So I could see myself potentially buying it and adding a little bit. Now, for these kinds of companies that are small cap companies, very, very small cap companies, less than $1 billion, I wouldn't recommend that you go overboard, because there is risk, of course. And also, if this is a flowers company, which obviously is, it's not a proprietary. There is nothing proprietary here. They're selling flowers, so they are a commodity company. Now, that's not necessarily bad, of course, but it lowers the burden for other companies to compete, and they don't have like patents, they don't have technology behind it, so it's about flowers. So you have to be a little bit cautious and value these companies at lower estimates, just because they don't have too much proprietary stuff that they are selling. So they are a commodity again, a company that's selling bread, a company that's selling cakes, things of that sort. These are commodities, and they can be replicated very, very easily by anybody. That's the point. So there can be tons of competition. And generally speaking, they have low margins too. So be careful about those. But if you understand all these and you are fine with it, I could potentially see adding some extra to some money to that. And of course, it's a retail, direct retail, and internet retail, so they do have some technology in terms of their website and stuff. But this is nothing to to be too confident about and too excited about, because lots of companies will have something similar. It's about flowers pretty much. So thank you for watching this one. I hope you enjoyed and you found it interesting. And let me know what you think about the company. Leave a comment below. Let me know what you are doing with FLWS. Are you a buyer? Are you thinking about it? And thank you for watching this video. Again, please leave a like if you enjoyed the video. And if you did enjoy this video, take a look at this one that I made earlier, and it's about Prosus, Tencent. It's about the companies that are trying to get discount on Tencent stocks, and I'm discussing whether it's worthwhile to buy one of those instead of actually buying Tencent directly. Thanks for watching again, and I'll see you soon, guys. Bye bye.